Learning the revenue recognition principle. But firstly, what is revenue? Revenue is an increase in resources that have been earned through the sale of goods and the provision of services. So, the revenue recognition principle states that revenue is to be recorded when it is earned and incurred. It is not when cash is received. This is a part of the accrual basis of accounting. Through recording revenue when it is earned and expenses when they are incurred, it provides a more valid accounting system. It supports the matching principle, and furthermore, it is advocated for use under the generally accepted accounting principles, otherwise known as GAAP. Now that we know we use the accrual basis of accounting, assuming the accounting period ends at the end of the month, let's look at examples to see how to record revenue and expenses. Our first example will focus on deferred revenue, or otherwise known as unearned revenue. This is when a company receives a payment from a customer for future goods or services. The payment is received and recorded as a liability, as the revenue is yet to be earned. Let's say a customer purchases a plane ticket in October with Qantas to go to Fiji. However, they do not embark the flight until December. So, when do we record this revenue? The answer is December. We record the revenue in December because Qantas can only then recognise the completion of their service. Again, this is known as the deferred revenue because the payment was received before the service. The next example will focus on accrued revenue. Accrued revenue occurs when goods and services have been provided and delivered, however cash is yet to be received. In this example, a lawn mowing company is providing a service in January. However, the company does not receive cash for mowing the lawns until February. So, when do we record this revenue? The answer is January. We record the revenue in January because when the lawn mowing company provides the service, it is immediately recognised as revenue. To recap, the revenue recognition principle states that revenue is to be recorded when it is earned and expenses when incurred. Deferred revenue occurs when payment is received for full goods or services. And contrarily, accrual revenue is when cash is paid after the delivery of the good or service.